The global financial system is currently built on the foundation of massive classical computation. Every day, trillions of dollars flow through markets governed by the Monte Carlo simulation, a method of calculating risk by running millions of random scenarios to predict the future price of an asset. While Monte Carlo has been the gold standard for decades, it is inherently slow and requires enormous processing power. In the high-frequency world of modern trading, even a few seconds of delay can mean the difference between $1 billion profit and a catastrophic loss. We are now entering the era of quantum finance, a shift that will redefine how we measure risk, value assets, and manage global liquidity. This isn't just an upgrade in speed, it is a fundamental change in the mathematics of money. At the core of this revolution is the Quantum Amplitude Estimation algorithm. While classical Monte Carlo simulations scale poorly, requiring 4 times the samples to double the accuracy, Quantum Amplitude Estimation offers a quadratic speedup. This means a quantum computer can achieve the same level of precision with significantly fewer steps. In the context of value at risk or credit risk analysis, this allows financial institutions to perform complex stress tests in near real time, rather than over several hours or days. This capability is not just about making more money, it is about systemic stability. If we had possessed quantum risk modeling during the 2008 financial crisis, we might have seen the contagion of subprime mortgages collapsing through the entangled web of global debt before it was too late to act. Beyond risk management, quantum finance is transforming portfolio optimization. In classical finance, finding the perfect balance of assets in a large portfolio, considering thousands of variables like volatility, return, and correlation, is an NP hard problem. It is mathematically impossible for a classical computer to find the absolute optimal solution. It can only find a good enough approximation. Quantum computers, using algorithms like the Quantum Approximate Optimization algorithm or quantum annealing, can explore the entire solution space of a portfolio simultaneously. They can identify hidden correlations and optimal weightings that are invisible to classical systems. We are moving toward a world of hyper-optimized wealth management, where capital is allocated with subatomic efficiency. This shift also introduces the concept of quantum arbitrage. In the classical market, arbitrage is the act of profiting from a price difference between two markets. As our markets become faster, these windows of opportunity shrink to microseconds. Quantum computers can identify these discrepancies across thousands of assets and multiple global exchanges instantly. But the real game changer is the ability to price complex derivatives, like path-dependent options, with absolute accuracy. Today, these are priced using approximations because the math is too heavy. A quantum computer can calculate the exact price by simulating the subatomic-like behavior of market variables. This represents a total information overmatch for those who possess the hardware. For the technology founder or the veteran, the move to quantum finance is a matter of economic sovereignty. Just as we discussed in the context of quantum sovereignty, a nation or an institution that lacks quantum financial capacity will find its markets being hollowed out by those who do. They will be trading against an adversary who can see the ground state of the market while they are still looking at delayed classical approximations. This is the new arms race of Wall Street and the City of London. We are seeing a massive recruitment of quantum physicists into the world's largest hedge funds and central banks. They are no longer looking for quants who understand classical math. They are looking for quantum quants who can write the software for the subatomic economy. As we move toward the 2030s, the quantum divide in finance will become a primary driver of global inequality. The institutions that successfully migrate to quantum-enhanced models will possess a resilience and a profit-generating capacity that classical banks simply cannot match. We are moving toward a world where money is no longer just a medium of exchange, but a form of information that behaves according to the laws of quantum mechanics. To understand finance in the 21st century is to understand that the invisible hand of the market is becoming a quantum wave function. The only question is whether you will be the one observing the collapse or the one caught in the interference pattern.